Happy Monday, everybody. I hope you had a great weekend. Today is April 24, 2023, and this is your Monday Market Update. Last week was pretty much as promised, at least what I promised you last week. For the most part, not so exciting, at least as far as how things look when you look back at the day-to-day. Let's do that. I'll try to spice it up a little bit for you. Stocks opened Monday after a quiet news weekend, slightly higher as they reacted to the only eco data of the day. There was some, and the market reacted, as I told you, just as they would, not too more than a fizzle here and there. Empire Manufacturing Index had a big surprise, and even under the surface, there was some good news. Manufacturing is coming back a bit, at least this month, at least in the Empire State. New orders too, so that's a good sign. Remember, we want Goldilocks. For the eco data needs to show that we are not falling off a growth cliff, but not so strong that the Fed worries about more inflation. Markets drifted lower at midday, then oil did pull back a bit, and since the markets needed something, that was a positive, since this week economists include energy costs in their inflation fear gauge. Note that that's not always the case, though. Stocks did recover a bit on that news, and the overall yawner of a day ended with all three indices up about 1/3 of 1%. You know how I feel about that? Algo trading. Quick note that Goldman put out, they noted that the tax receipts are coming in soft. The debt ceiling could be an issue earlier than everyone thought. They're talking about June now. The showdown will be soon, so keep an eye on that. We're starting to hear more about this. McCarthy actually showed up at the New York Stock Exchange to pitch this, his side of this. Not too subtle. Stocks started a bit higher again on Tuesday. China GDP is back on the upside, only 4.5% compared to the teens they used to put up, but it is positive and it beat expectations. Just think global growth. That had to offset the hot wage inflation print in the UK and other hot Eurozone eco data. Inflation and restrictive monetary policy remains the headwinds of the economy. That was the line in the German release. Nothing new. Earnings from big banks kept on coming in, underwhelming. Then we had the Fed head Bullard hit the tape that he thinks that restrictive is 5.5 to 5.75% of the Fed fund rate. And that, as we've discussed, is not what the markets are pricing in. That's not just a May hike, but at least two more. Bostic tried to take the other side, sort of, but he talked about one more hike than a pause. That is the market's tune. I love the research that is pointing out that after about a dozen companies that have reported, we are 71% beating estimates, in line with history. Really? Maybe 12 to 14 companies from the S&P 500? 500. Remember that last week we had 20% of the S&P, but not by Tuesday. If you thought Monday was boring, Tuesday ended with all indices up or down less than 1/10 of 1%. There's a lot weighing on this market, and we've spoken a lot about it, mostly the Fed, but remember consumer. Can they keep up? There are competing narratives. First, note that a lot of money went to consumers during COVID, including PPP loans, and according to a Yahoo Finance report, 90% of those loans were forgiven. More stimulus, and estimates are that there's $5 trillion in money markets on the side. On the other side of that narrative, consumer debt hit a high, $4.8 trillion in February. Millennials' average credit card debt rose nearly 30% in a year, and Gen Z credit card debt up 40%. Finally, 20% of Americans who use the new buy now and pay later app use them for groceries, in case you just thought that was for Pelotons. Foreclosures are also up 22% from last year. The top 4 Wall Street banks have also written off $3.4 billion in bad loans in the first quarter of 2023. Netflix reported earnings after the close on Tuesday. They will stop sending out DVDs. Did you know they still had that service? Fun facts. Last DVD will mail September 29, 2023. First DVD title that was sent in 1998, Beetlejuice. The most popular DVD that was sent, Blind Side, in 2009. 5.2 billion discs went in the mail since they started. Do you remember them before they had original content? First original content? House of Cards in 2013. Okay, back to the recap. Then came Hump Day, as it always does. Wednesday had stocks gap lower by about 0.5% across the board, and the research I read thought that that was notable. I guess when we close within 1/10 of the open, 0.5% is notable. We had hot eco data from across the pond. UK CPI up over 10%, and that is a kind of reversal. Is not what we want to see. We did get oil prices to drop again. Remember, that is this week. That's good for inflation estimates. Quick reminder for when people care again. The higher oil comes when global growth is expected. Fed Beige Book, another one that is usually ignored, actually was interesting this week. Maybe they'll change the color overall. There were lots of comments on the health of the economy in the wake of the bank crisis. Not too bad, but it was not ignored. By the end of the day, back to sideways, Dow down 0.25%, the S&P and NASDAQ nearly totally flat. A few notes on the upcoming eco data and why we may be feeling a bit sleepy. First of all, the market seems tired. A lot of action recently and may just rest a bit, but also, as we spoke about last week, not too much real meaty data. PCE is this week and will be on the countdown to the Fed meeting in May. Then we'll wait until the June 15 meeting, and before that, we get a lot of data. 2 CPIs, two PPIs, and 1 PCE. That's a lot to chew on. 2 other bits to think about. Ukraine, remember them? The corn and wheat exports are going to be about half of what they were before the war. Will that be inflationary? And did you see the parking debt collapse in New York? Tragedy with a life lost and others injured. A recent report out of the UK points out to how much more EVs weigh than their gas-guzzling predecessors. This goes a long way with the question, is our infrastructure really ready for these EVs? Thursday opened like looked a lot like Wednesday, gapped lower, but then bottomed within the first 15 minutes. Lots of stock-specific news. Get used to that. It is earnings season. Last week was about 20% of the S&P. This week is the Super Bowl. Quality and quantity. Big tech names are coming in this week. Amazon, Alphabet, Meta, and Microsoft. We also see some of the other biggest companies in the world. Visa, MasterCard, Verizon, McDonald's, and Coke. About 178 companies, about a third of the S&P 500, about half of the Dow. Eco data was big too. Jobless claims were higher than expected, showing cracks in the labor market, and the Philly Fed survey was a huge disappointment, opposite of what the Empire survey that we got earlier in the week. Remember, these jobless numbers are real people, but in today's bizarro world, bad is good. It was not as bad in the details as the headline. New orders were better, shipments and unfilled orders were better, and most importantly, for inflation watchers, prices paid and prices received both turned down. Fed Head Mester was out on the trail and mentioned again, one more hike and then hold. It will be a while to get inflation under control. I am in the hike in May and pause camp, just one man's opinion for today. Oil did fall, and recall that is good these days for the inflation warriors, but by the end of the day, not so exciting still. Dow down 1/3 of 1%, S&P down a bit over 1/2 of 1%, and the NASDAQ down just over 3/4 of 1%. Stocks kept up the pattern, opened little change on Friday with not so much news on the eco front here or abroad. The U.S. eco data was a bit stronger than expected, but did not move the needle much. Earnings were on the better side as big names in consumer, Procter & Gamble, and transportation, CSX, reported, and both were up on those reports. As of Friday morning, 88 companies in the S&P, or 17%, have reported. 61% beat sales estimates, and 76% topped earnings estimates. Overall, the earnings, if they keep this pace, are on track to fall almost 5% year over year. Revenue on track to grow by almost 2%. As you can see, margins are getting squeezed. As the closing bell rang on the day, on the day and the week, just a whimper, as I've told you about for the whole week. For the day, all 3 averages were right about flatline. Dow down a bit, NASDAQ and S&P up a bit. For the week, Dow and S&P down about 1/4 of 1%. The NASDAQ was down just under 1/2 of 1%. Let's take a look into this week. As I mentioned, it's a big earnings week. In addition to the earnings, we'll get eco data throughout the week, but nothing earth-moving until Thursday GDP for Q1, along with the jobs numbers. And Friday, we'll see the PCE. As we know, the Fed loves to watch this one. University of Michigan surveys too. Fed heads, none. They're in blackout period before the May 3rd FOMC meeting. The question is, as I've been telling you, will we focus on the earnings and the forecast from the companies? That is what drives stock prices in the long term. There will be little else to react to. So will this be another sleeper of a week? Don't bet on it. Not these days. There are plenty of reasons to be on either side of this, but the list of the compelling concerns about the sustainability of the recovery can include valuations, as I keep mentioning, uncertainty about the Fed, tightening credit conditions in reaction to the banking turmoil, interest rate volatilities, declining leading economic indicators, contracting manufacturing data, and even the debt ceiling drama. On the other hand, the conviction that we've already priced in all of that list, or at least most of it. We also have a lot of money in money markets and on the sidelines. And on the contra trade, that is the idea that things seem so bad that anything good tips the boat pretty fast. We'll just have to keep watching. Remember, this is a marathon, not a sprint, so keep your eyes on the long-term goals. Be ready to deploy investment dollars if it fits your price levels and your risk levels. Please engage with me. This is not the time to hide. This is the time to prepare tactics for this market and this time. Stick to the plan, as I've spoken a lot about. If you can and if it fits your goals, make consistent deposits to your investments. Know what you own and why you own it, and keep your shopping list ready. Come back on Friday for a planning video with more ideas on what we can do to give you a better chance to reach those goals. Set it and forget it is no longer always the best plan. It could be, but let's check in on that. Keep in touch, stay nimble, expect the unexpected, and have a great week.